I'm going to put up on the screen here first our summary, at least, of what is in the Senate version that has been passed already. And then we can back out to how it compares with what the House is likely to pass today. And as you know so well, it's going to exempt, as I understand, the Senate will exempt small banks from the Volcker Rule, and it sets one ratio for capital requirements and reduces frequency of regulatory exams. How does that compare with what the House is looking at today?
The House, David, good morning. The House is going to pass that same version of the legislation. There's been a conversation in the House about doing additional things, both through legislation and regulation, and we support that. We can talk about some of those things. But what the House is going to take up today is the same bipartisan, thoughtful, common sense bill that was passed in the Senate just a few weeks ago with Republican and Democratic support. We expect the same sort of bipartisan approach in the House later this afternoon, sometime mid or late afternoon. And we're really excited about it. This has been years in the making. This is not something that just popped up here over the last couple of months. This has been the result of bank leaders and CEOs who've been coming to Washington talking about some of the unintended components of the public policy response in the form of Dodd-Frank that were making it harder to serve their customers, clients, and communities. So this is not, I've seen a lot of the reporting. This is not a huge rollback of the whole thing, and it's not a giveaway to Wall Street, as many have said. These are thoughtful, common sense, bipartisan changes, particularly aimed at our nation's community banks, mid-sized banks, and some regional banks. I would say, though, David, the legislation's not perfect. It still keeps into law some of these the artificial asset thresholds, for example.
Right.
We'd prefer to see banks supervised based on business model and risk profile, which we think is a more thoughtful way. We'd like to see the regulation tailored appropriately. But make no mistake, this is a huge, important step forward. We hope the first of additional steps to modernize and properly tailor the supervisory framework.
So, Rob, I want to take you back just a half step, and if the Comptroller could put back up that last list we had that compared the Senate with what they passed with what the House had proposed, because I want to ask about the things that the House had proposed, which went further, like just doing away with the SIFI, repealing the Volcker Rule altogether, bankruptcy instead of orderly liquidation. Those things, I understand, the Senate has now moved away from, the House has moved away from, will go along with the Senate. Does that mean that the House requests are just gone forever, or do you think those will come back at some point?
No, I think a number of those will come back. Chair Hensarling, Jeb Hensarling, who has been an advocate for regulatory relief, has worked with his colleagues in the Senate, and I know he intends to bring forward additional measures later this year. His focus, though, is to bring forward the bipartisan measures that the House Financial Services Committee has been working on. So I don't think all of those, David, are likely to become law later this year, but I think the bipartisan things that the House Financial Services Committee has been working on will be probably taken up in some form or another. You got to remember also, though, there's a really important role that the regulators can play. So apart from what's happening over on Capitol Hill at the Fed, the FDIC, and OCC, there's a really thoughtful series of conversations around a host of regulatory measures that we think is very positive. Again, not to do anything to erode safety, soundness, financial stability, or consumer protection, but just to right-size this rule set.
So let's go to exactly what you're talking about, what the regulators could do. We'll put a list up here of some of the things that Bloomberg has reported that they are seriously considering moving forward with, specifically doing away with that 60-day presumption on speculation by the banks, and also really cutting back on the documentation on hedging. Those are the two things that Bloomberg in the last week has reported about. What can you tell us about what the regulators are likely to move forward with on this?
Sure. We are going to see on the what you're referencing, of course, is the Volcker Rule. And listen, any regulation is only as good as its implementation. And from day one, there was a recognition that this rule needed improvement. There were vagueness. There was hard to comply. And so there was a conversation with regulators, even the Obama-era regulators, who said, gosh, we need to get this right. So we think very soon, led by the Federal Reserve and Randy Quarles, you'll see a new Volcker 2.0 proposed. We look forward to seeing it. We haven't seen it yet. But again, to remove some of the complexity and the vagueness so that this rule can be put on the books, we think that makes sense to modernize that and look at that and address those issues. And then also, of course, the idea of having a single regulator for Volcker also we think makes sense, as well as what's in the legislation. Kind of the third piece of the stool here is exempting community banks that don't have big market-making components. So the under $10 billion, having them be exempt probably makes sense as well. So there's been a thoughtful conversation around this particular part of the policy policy response. And you've had regulators on the left and the right who said, hey, we need to clean this up. This just isn't quite doing what it's intended to do.
And I know how important that bipartisan approach is to you, Rob, but you live in Washington. Terribly important what happens in Washington. But take us across the rest of the country for a moment. When we get this new version out of the Congress, today it appears will be voted on by the House, and we get the Volcker 2.0, what difference is it going to make in the real world?
Well, it's going to be easier for banks to serve their customers and their clients and communities. That's what's most important. Banks do well, of course, David, when their customers do well, when the economy does well, when you have enhanced jobs and prosperity. So this is really not about the banking sector. It's about the customers and clients that we serve, small, medium, and large. So when this bill is passed, obviously, the bulk of this bill is focused on banks under, the 98% of the banks in the United States that are under $10 billion in asset size. But it also does some important things for mid-size and some of the regional lenders. Mind you, there are a number of regional lenders who are not seeing relief from this bill that we think should, be subject to additional tailoring. And those are things that we're going to be continuing to work on. But again, what this will do is make it easy for primarily community banks, but also mid-size and some regional banks to serve their clients, be it commercial clients, residential clients, or to make it easier, for example, to do a plain vanilla mortgage.